Okay, folks, this is Glenn Corso. I'm Executive Director of the CMLA, Community Mortgage Lenders of America. Thank you all for attending this webinar, and we're now ready to get started. What I'd like to do is spend 1 minute right up front talking to you about CMLA, the Community Mortgage Lenders of America. We are a trade association based in D.C., and we are advocates for mid-size and small community-based lenders. We represent your point of view in D.C. in front of Congress and the regulatory agencies. And our board of directors and our membership is entirely mid-size and small lenders. We don't care what Wells Fargo thinks or Citibank or anybody else, because we don't have to take their views into account, only yours. We are very active on GSE reform. We put together a coalition on the issue, and we also have a lot of interaction with the Consumer Financial Protection Bureau, including meeting with the director twice a year, face-to-face. A group of our members get to talk to him about issues that are on their mind. So if you want access to decision makers in D.C., either at the regulatory agencies or in Congress on issues that are affecting your business, you really should be part of our organization. You can see on the screen, there's my contact information, gcorso@thecmla.com, or the telephone number. So give us a call. If you're an MCT client or an AMLG client or a Lenders One member, you could qualify for a discount on your first year dues. So we'd be pleased to give you some additional information or to talk with you and your management team. So with that, let me turn to the subject of our webinar. We're going to hear today from Phil Rizzori, who is Chief Operating Officer for MCT, Mortgage Capital Trading, and he is going to talk to us about this FINRA rule, which is going to affect your trading in the secondary market and your margin requirements. So without further ado, let me turn it over to Phil.
Well, thanks, Glenn. And, first let me compliment or applaud the CMLA for, having a webinar on this specific rule. I think that we were at a conference of the CMLA. I think in 2012 we spoke when this rule first came out, or the amendment, I should say, to the rule. And definitely apropos for CMLA members, because it's basically a rule, as we'll talk about, that really makes the business, with regards to hedging, more capital intensive, but then truly causes what we believe, from a solvency perspective, for lack of a better term, an existential risk. So we definitely want to talk about, kind of our recommendations for mitigating that, or, kind of hedging this new risk to hedging. So I'll be able to hammer through this in probably about, I'd say, less than half an hour, and then we can go through and talk a little bit about, talk through any questions that anybody has, and Glenn will be driving the whole presentation. So just a little bit of history. In 2012, the TMPG, Treasury Markets Practices Group, which is an industry group, basically proposed an amendment to FINRA 4210 that would add in the coverage of TBAs. So, just as it says here, the proposed adjustment basically for TBA lines would include a 2% maintenance margin and a mark-to-market required mark-to-market call for negative positions in excess of what's referred to as a de minimis transfer amount of $250,000. So just to go through that, just to pick that apart here. So there's two forms of margin that you have or could have to deal with in the future. When you think of margin in general, most people think of a percentage of the open line that you would put up to open the line. That's what's referred to as maintenance margin. The mark-to-market call margin would be basically based on your open exposure, the position, that trade were to take, depending upon where the markets went between the current mark-to-market of the trade and when you actually executed the trade. And actually, I'm sorry, I should step back here. I'm going to, just in the interest of time, I'm going to expect that everyone on this call is, familiar with hedging. Obviously, if you're not hedging, this has really no effect on you. So I'll maybe quickly review kind of the mechanics of a short position trade that you hedge with your, against your long positions on your pipeline. But in the interest of time, we're going to, assume that you're well aware of all of these mechanics. But basically, your pipeline that you're going to be hedging, or you are hedging, you're long that pipeline. The interest rate lock commitments put you at a long position. The offset, the TBA hedge position, which is by far and away the number one vehicle to hedge with, especially all the production that's being originated in today's market, that is going to be a short position. The definition of a short position is you profit from a decrease in value of the asset. You enter the trade by selling, you exit it by buying. So when we're talking about FINRA 4210 here, and we're talking about a negative position, we're talking about purely a situation in which the market rallies. Now, the good news here is I think there's probably a lot of people on the call, and a lot of people still joining the call that, probably don't assume that the market's going to rally, too much in the near to intermediate future. However, as we all know, we don't want to make an assumption about where the market's going to go. And this is a live mark-to-market, which we'll talk about in a second. But it could be very applicable depending upon your trade sizes. So that's a quick review. Again, this is basically, to go to the third bullet point here, TBA positions resulting from mortgage pipeline hedging are exempt from the maintenance margin, but not from the 250 de minimis transfer amount. So what that means is if your open trade positions in aggregate with a broker-dealer basically go out of the money in excess of $250,000, the broker dealer is required to call you for that margin, for that amount. Now, when I say that amount, there is there was some clarification coming from FINRA very recently on what what is needed. So let's just take an example of let's say a $10 million trade position that is out of the money 3 points. So that's a $300,000 exposure. You don't have to bring that back to zero. You would basically just need to bring that within $250,000. Now, when I say you don't have to bring that back to zero, this is what FINRA is requiring the broker-dealer to make you do. The broker-dealer, as we'll talk about in a second, it's completely up to the broker-dealer on what they want and kind of what their margin policies are. We'll talk a little bit more about that. Last thing, it applies to all FINRA regulated broker-dealers, and we'll talk about that in a second. Glenn, if we can have the next slide. So basically, again, it was 2012. For those of you who have hedged since 2012, undoubtedly you've heard from dealers, from probably groups like ourselves, hedge advisors, a lot of secondary market participants have kind of on and off talked about this thing since 2012. And in the last couple of years, I'd say 2014, 15, it was pretty quiet. And so here's the reasoning for that. There was FINRA 4210 covers a ton of transactions. We don't even pretend to specialize or know about 90% of the transactions that FINRA 4210 is covering. We are laser focused, obviously, on the TBA side because that is your hedge vehicle. The bottom line is that there's a lot of complications and confusion in the market as the SEC kind of decided whether or not they were going to go through with FINRA's recommendation on an amendment to 4210. So they basically halted the implementation, and that's kind of why you had this, frankly, kind of boy who cried wolf situation with broker-dealers. I'm sure you've had a bunch of broker-dealers come to you saying, hey, this rule is going to come. Then it never came. Then this happened, I would say, at least 2 or 3 times for the first 2 years of kind of their desired implementation. Really what changed things is middle of last year, the SEC approved the amendment with basically an 18-month implementation date. It was really scheduled for December 15th, 2017. And then in September of this year, so 2 months ago, FINRA recommended a 6-month extension to implementation. Now we have a target date of June 25th, 2018. Again, easy to say that, this thing's been extended, could be extended again. There's no question about that, but the difference now is the SEC has approved this amendment. The SEC had not done that before middle of 2016. Glenn, if we can have the next slide. So, basically just what are the implications here? It's probably obvious for most all of you on the phone. The risk here is that it requires a cash experience on open TBA positions. And for those of you who hedged, that's a problem because you've got 2 cash flows in a substantially rallying market. If we take the good old days of QE, when we had those big rallies of 2012, 2011, even in 2016, prior to the election, you've got trade positions that are substantially going out of the money as the underlying asset improves in value, and you've shorted them at much lower levels. So you've got trade positions that are going way out of the money, which is never, generally not a problem because you've got your loan positions that are going in the money. As you guys all know, there's risks to hedging, and you've got your pull-through that you've got to manage and executions that you've got to manage, float downs, renegotiations, all that good stuff. But for most of you that have hedged through quantitative easing and made it, you probably have a pretty good handle on that, or your hedge advisor, like ourselves, does. And so what the new exposure here is that you've now got a situation where in the middle of, let's just take a 45-day lock, and using our our volumes down here, let's just go with 25 million, which is around, takes a 100 basis point hit on 25 million is 250,000. That breaches this de minimis threshold. So obviously 250,000 is not a extremely big number, but when you get into a 3 and 4 point hit, move, that would be a substantial cash position, given for a lot of you guys, given that your loans that are in the money have not closed. So again, that's really the difference here. Now, just to take a step back, a lot of you on the phone already deal with this. There's some very reputable, very big street broker-dealers that have always required $250,000 threshold. So you go 251 negative, they immediately call you for 250. A lot of you guys already deal with this, but there is a good percentage of you guys on the phone, because a good percentage of our clients have enjoyed the broker-dealer, kind of taking that exposure. And so that's going to be a change for those of you that are, extremely cash sensitive. This is, this is really meant, this entire presentation, obviously, and kind of the implications of the rule are meant for you guys, obviously. And again, going back to, the reason it's good the CMLA is having this call. This obviously is a competitive advantage for a depository. This rule coming in. So again, exposure grows linearly with positions. Obviously, a $10 million position needs a 2.5 point move to breach the $250,000 threshold. Now, one thing I haven't talked about when I talk about market movement, I talk about a $25 million position needing to move 100 basis points out of the money to hit that threshold where now you could be called for that mark-to-market. That does not include, of course, other costs that are involved with hedging when we talk about market movement. There's what's referred to as roll cost, or also referred to as burn time on the hedge. It's just the time value of money. All of you who hedge already deal with it. And as you guys know, if we look at the tradable months right now of Class A conventional 30-year, we've got November, December, and January. And as you guys know, November will it would be December, January, February. As December converges, as we go through the month, December will basically, January will converge upon December, basically because of the time value of money there. And so your roll cost right now, as everybody knows from the news, we've got this flattening yield curve, which is a very good thing for mortgages comparatively. However, in a steep yield curve environment, we've seen, and it goes back a while since we've had steep yield curves, 14, 15 years ago, 2003, we had a 13, 14, 30-second rolls. And so when you get if we 14, 30-second roll, you're north of 40 basis points per month. So what that means is that if the market does not move at all, your position is going to deteriorate 40 basis points throughout the month. Now, I don't have to tell you guys this. It's not like you're hedged. That would mean you shouldn't hedge, because what that means is on best effort rate sheets, there's going to be a larger differential between a 15-day delivery and a 45-day delivery. So obviously the whole market has to deal with this. But the point is that as the time value of money kind of increases, the roll cost becomes a bigger effect here. And so you can see, again, with large positions, this is going to require you to, transfer money on these mark-to-market calls without even having a corresponding, market move of the magnitudes that I'm listing here. Glenn, if we can go to the next slide. So kind of assessing the impact to you of 4210. First and foremost, like I said, there's a lot of you guys on the call that are already dealing with margin. You've probably got, some of you guys have, some of your broker dealers have repo deals where you're making good spread on your maintenance margin, and there's the key there is going to be communicating with your broker dealer about, if I've got, let's say you've got $250,000 up for a $15 million line. The broker dealer is not required by FINRA to make you have that amount. The reason that's important is that, if that $15 million line that you have, if that goes out of the money, let's say $350,000, in that example, FINRA would see that you've got $250,000 posted, which brings the net down to a net negative $100,000, and that broker dealer is not required to call you for the mark to market. However, the broker-dealer may have that from a capitalization situation. They simply may need you to have that 250 up just for opening the line. And if that's the case, they may still call you for that mark-to-market. So it's going to be essential to talk to each and every one of your dealers with regards to, their policies on the margin. We talked about how it's, if you just need to get the position under 250,000 to stay within FINRA's rules, but that is not. And so again, using an example, let's say we have a position that's $300,000 out of the money. Technically, you only need to wire $50,000 or $50,001 to get it under 250. However, that may not be your dealer's requirement. Your dealer may want to, if you breach 250, they may want you to bring it back down to zero. So you need to communicate with all the dealers on what their policies are and if and when they are going to change, with simultaneously as FINRA 4210 becomes implemented. Assessing, like I said, the other piece here is, and we haven't talked about this, is there is nothing fair and equitable about this rule. Let's be very clear. The Fannie Trade Desk is exempt from this rule. FDIC bank broker-dealers are exempt from this rule because those that are not FINRA regulated. Now, just to be very clear, there are a lot of bank-owned dealers, some very big names. I can't mention any names on the call, but there's some very, very big names out there that are bank-owned broker-dealers that are FINRA regulated, and as such, those will be subject to the 4210 amendment. So, again, this is something that you need to talk to all of your dealers, especially the FDIC bank dealers, because there's going to be there's going to be some difference bank to bank on that. But obviously, for certain lines, Fannie, first and foremost, this is not going to be relevant for. Now, just to speak to the Fannie situation for a second, I think there's a pessimistic way to look at that, and I think a little bit more of an optimistic way to look at it. The pessimistic way that I think a lot of market participants are looking at it, or basically saying that this is another example of a government backed organization getting an unfair advantage. I think a little bit more of an optimistic way to look at this is FHFA basically just saying, look, this is a bad rule. This creates a potential existential risk to an organization from a solvency perspective, and we don't agree with it. So that's I think that there's definitely, and we FHFA hasn't, made it, any official announcements in that regards, but some people that we know that are, kind of close to the situation over there, that's kind of their thinking. But again, as it pertains to you need to obviously assess the relevance for each trade line. Glenn, if we can have the next slide. So I talked about, clarifying with the broker-dealer, and I think that's really important because, it's really most broker-dealers that we talk to were under the understanding that you had to bring your position down to zero, and you basically wouldn't get your cash back until everything's settled out. So let's talk about the settle out. What I mean by that. If you've got January positions that are out of the money in excess of 250,000, and your dealer wants you to bring that back to zero. Let's just say you've got 400,000 now of mark to market. If the market sits there and doesn't move, you're not going to get your money back when you close out of those positions. So let's take a November 16th today. if we were, let's just say that maybe we your secondary marketing manager overshot on your settlement date. So instead of doing it December, they were doing some January Class A securities. Let's say you closed your loans a little bit early. Let's say you close them beginning of December. Now you're hedging with January securities. So you're going to pair out in a transactional. Let's just pretend for a second you're not recycling trades. You pair out of your corresponding position. From the dealer's perspective, you're still at risk. They are still at risk. And again, more importantly, from FINRA 4210's this amendment's perspective, that dollar amount basically remains exposure until settlement. So once settlement crosses, you would get your in my example, you would get the $400,000 back. But again, using my example of where you were kind of at that kind of crossover period of deciding of whether or not from a hedge position you put on a December or a January, and I should have been a little bit more descriptive in my example there. Let's just say a loan that was locked on November 1st. Let's say it's a 40-day lock. Let's say you got a 5-day buffer in there for the investor delivery. So you got a 40-day lock. You're at December 10th. That's pushing it, especially if you were going to try to get into an assignment of trade or something like that. So you're going to push that into January. Let's say that loan closes early, so that 40-day lock closes end of November. Now you've got the loan closed, and the position is out of the money. Now in that scenario, you potentially you would get your money back from the investor, provided that your loan improved in value based on the equivalent in an equivalent manner as the trade went out of the money. But the bottom line is that the cash that you've wired out to the broker-dealer won't come back till settlement. So in my example, it wouldn't come back for another 42 days or so. So again, the reason I bring that up is that it's important from the broker-dealer, for you to clarify with each broker-dealer their interpretation and kind of how they are going to implement any changes to their policy with this rule. Again, the bottom line is they're only required to get you to bring the net exposure within 250, not all the way down to zero. Next slide, please. So again, hedging, this, as we call it, the new risk to hedging, basically pretty simple. Your first order of business, obviously, would be to prioritize trading lines that are not subject. So again, like I said, it's not necessarily a fair rule, but obviously, trade desks like Fannie. Again, I'm using them as a name because they're so unique. They get an advantage here. There's no question. So to the extent that you are, cash sensitive and using other dealers, your dealers that are subject to 4210, we get the question, and we've gotten the question a lot from our cash-sensitive clients. Phil, how are you going to keep us from getting into a solvency crisis if we have a huge market move? And it's very simple. I mean, it's simple math. You have to diversify your trading lines. That's the bottom line. And very, very simple math here. You've $25 million position, breaches at 250,000, breaches 250,000 at 100 basis points. We talked about that if even in the current roll costs, that's only going to, by the time bid offer spread is there, you're only talking about maybe an 80 basis point market movement. $5 million, again, simple math, breaches $250,000 at 500 basis points. Kind of just looking back yesterday through Bloomberg, we've really only done that in a market coupon. Again, not a Fannie 2.5 or something, but a market coupon at in kind of the 101 to 103 range. The market coupons have only done that since the beginning of QE. Have only done that twice in a 45-day period. So it just shows you that you can, substantially reduce your risk. Obviously, this is not feasible if you've got a $250 million pipeline, having however many broker-dealers that is. I guess that's it definitely wouldn't work for large pipelines. But again, if you're doing $250 million in production, you probably got a little bit more, cash cushion there. So again, to the extent that you're, when somebody asks us, or for those of you on the phone trying to figure out, okay, we're cash sensitive, how are we going to, completely mitigate this or mitigate it as much as we can? Any potential cash exposure, it would be, prioritizing the lines, diversifying the broker-dealer lines that where it is applicable. Those are kind of the number one and number two. And then, as you kind of go down the list here, we are a big fan, as assignment of trade has kind of gone by the wayside, over the past few years because of the dominance of bid tape executions. You really got into the situation to minimize your bid offer spread costs. Most of you on the phone who are hedging, you're engaging in a form of trade recycling where, you're setting a hedge out in January or February. You close a loan, and on a transactional basis, instead of committing the loan to the investor and immediately pairing off the trade with the broker-dealer, you use that loan sale commitment as an effective hedge for the new production coming into the pipeline, and thereby recycling the trade, cutting that bid-offer spread in half. That, is a problem when we're talking about an absolute value of $250,000. Increasing your duration of your hedge does two things. First and foremost, it increases the possibility or the time horizon that the market could move. And then number two, it increases, as we talked about before, it increases your roll cost. So if your roll cost is a quarter point, now you're half point. So if we think of the $25 million position there, we talk about how it breaches at $250,000 at a 100 basis point market move. Well, with the market not even moving, we're halfway there, right? With a quarter point roll cost in 2 months. So that the bullet point number 3 there would be you would minimize the amount of long trades that you're doing with regards. Obviously, you need to match your lock terms to your trade lengths, but we would minimize the amount of trade recycling. Now, the fourth bullet point here, utilize AOT execution where economically feasible. That's been hard to do, frankly, because there's just, like I said, you've got non-assignable executions on the, Fannie Freddie cash windows. With regards to Ginnie securitization, most of you on the phone who do that, you're doing specified settlements, so you're not delivering into the security. And then, of course, from the aggregator perspective, and I know a lot of you guys are selling the majority of your production to the aggregators. The aggregators, as I said earlier, have moved to bid tape execution, which is, pretty much dominating the execution space right now. However, we do think that that's going to change. We're pretty confident that's going to change in 2018. There's some real exciting stuff. I can't name names, but there's a couple large investors, some of you may already be familiar with this, who are working on bid tape AOTs. It's the reason it changes the AOT perspective versus years ago when people were doing AOTs all the time is now there is a better, I should say more automated way that these investors are looking at for blending trades, and so it kind of takes the tolerances out. So for those of you that did AOTs before with, let's call it, sub-$100 million pipelines, it was a real pain trying to make these tolerances. The blending and combining of trades that some of these investors are looking at doing is pretty exciting there. So we expect assignment of trade to into 2018 to become quite a bit more prevalent, especially at certain investors. Now, AOT doesn't completely solve the problem because as those of you who have done it with some of these investors, they're not stupid from a standpoint of risk, right? They don't want you just taking 10 million of trades that are 500,000 out of the money, throwing the trades to them accepting the assignments, and then the loans not coming. So what that means is a lot of investors have set up policies to where they will not accept an assignment until a certain percentage of the loans have hit their doorstep as far as collateral. So using a very big investor out there, their rule is 50% have to hit their desk for them to accept the assignment from the dealer. Again, once they've accepted the assignment from the dealer, that exposure will evaporate from your FINRA calculation. Next slide, please. And so just a summary here. Again, the actual implementation of this, although it sounds like we continue to talk about this over the last 5.5 years, the implementation appears to be highly likely. Mainly, the main difference here being that the SEC has approved it, and even though we've got this extension, highly likely. I think. Again, I don't have any data on this with regards to anyone at FINRA or at the SEC, but I think a caveat here would be like I say here, the extent to which FINRA dealers can kind of successfully argue that there's a true unfair kind of standard here. If the FDIC is not going to move this direction, and of course Fannie is definitely not moving this direction. Again, highly levered positions, that needs to be at a dealer that's FINRA regulated. Needs to be closely monitored, and then like we talked about in the previous slide, the kind of the 3 ways to mitigate your risk, and they literally are in this order. Dealer prioritization. That's going to be number 1. Again, not a fair thing, but if you ask me how do I mitigate the risk, it's going to be traded dealers that do not call you. Then trade line diversification, get more dealers, and the last is kind of active trade management. Now, just to talk about active trade management, and I know I've blown through the half hour here. What I mean by that is AOTs, if you have the loan collateral, you can sacrifice, some execution and get a trade off your open position. What do I mean by that? Well, maybe you've got some loans. If we're at November 16th. Let's say you got some loans you can deliver in the next 5 days. Well, that's going to beat the Class A requirement for AOT of December. That's going to beat, I would imagine December sometime, around Thanksgiving next week. Generally, it's about the 25th of the month where the last day you can deliver a December security. So what that means, or deliver for a December security, What that means, though, is that let's say you got a ton of January trades that are, and let's say one real nasty January trade, you could take a longer delivery on that, assign the trade over, and as long as you get the, again, this is investor by investor. You have to communicate with your investor on this, but as long as you have the files delivered, at a lot of investors, that exposure will come off your open position. So, Glenn, I think that pretty much does it for my content. If you want to go through some questions.
Okay, Phil, thank you very much. That was really good. Folks, so what I'd like to do is before I switch to the Q&A session, I just want to tell everybody we are recording this session. And so at the end, later today or tomorrow, we'll send out an email to everybody who signed up with a link so that you can access the recording or access the slides either for yourselves or if there are other folks in your company who would like to hear it. Okay, so with that, let me switch real quick to the Q&A section. Okay. So what you can do is let us know. You can dial 6 on your phone, or you can click the Q&A button from the toolbar if you're with us online, and you'll go in the queue, and I will pick you out, and we'll take your question, and Phil will answer it. Phil, it looks like you did such a bang-up job that nobody has a question. Anybody at all have a question? Okay, well, Phil, thank you very much. You and MCT did a fabulous job for us and for everybody on the phone. And with this, we'll conclude the webinar. And remember, you'll get a link if you want a recording of it or you want to see the slides again. Phil, thanks a lot.
Appreciate it. Thanks everybody for your time.
Take care.
Thanks, guys.
Bye-bye.
Bye.